Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager with Rame & Gorell Wealth Management. Today, we're going to discuss a unique tax strategy for high earners, the Backdoor Roth IRA. If you or someone you know could benefit from this strategy or any of the other services that our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to identify opportunities for optimization in investments, tax planning, estate planning, employer benefits, and retirement strategies. Before we get started, let's review IRAs at a high level. An individual retirement account, or IRA, is a type of tax-advantaged investment account created by Congress to help individuals save for retirement. These accounts can hold a variety of investments, including stocks, bonds, mutual funds, ETFs, and more. All IRAs offer tax advantages, but it's important to understand the differences between the two most common types, the traditional IRA and the Roth IRA. The key difference between a traditional IRA and a Roth IRA is taxation. In a traditional IRA, contributions may be tax deductible, and all taxation is deferred until withdrawals occur, often decades later. In a Roth IRA, contributions are made with after-tax dollars, meaning taxes are paid up front. However, distributions during retirement are generally tax-free, including any growth that has occurred. So, who should prioritize a traditional IRA contribution versus a Roth IRA contribution? It comes down to the investor's current tax rate versus their anticipated future tax rate. If your current tax rate is lower than what you expect to pay in retirement, Roth contributions are preferable, since you would rather pay your lower tax rate today and enjoy tax-free distributions later. If your current tax rate is higher than what you anticipate in the future, pre-tax contributions to a traditional IRA may be better, allowing you to defer taxes until a time when your rate may be lower. Now, let's discuss eligibility for these types of accounts. In 2026, a single filer with a modified adjusted gross income above $91,000 or a married filer with modified adjusted gross income above $149,000 cannot deduct a traditional IRA contribution if they also have access to a 401k or similar employer plan. For Roth IRAs, contributions are entirely disallowed for single filers with modified adjusted gross income over $168,000 and married filers with modified adjusted gross income over $252,000. The inability to deduct traditional IRA contributions and the income limits on Roth IRA contributions are what make the Backdoor Roth IRA strategy so powerful. Here's how it works. An individual who earns too much to qualify for a traditional IRA deduction or a direct Roth IRA contribution instead makes a non-deductible contribution to their traditional IRA. Since no deduction is received for this contribution, the money sits in the IRA as an after-tax balance. However, rather than keeping these funds in the traditional IRA, they are subsequently converted to a Roth IRA. While income limits restrict direct Roth IRA contributions, there are no income limits on Roth conversions. Once converted, the funds in the Roth IRA grow tax-free, just like a direct Roth IRA contribution. As long as future distributions meet IRS qualifications, 100% of the Roth IRA balance can be withdrawn tax-free. In addition to tax-free growth and withdrawals, Roth IRAs offer other key benefits. Unlike traditional IRAs, Roth IRAs are not subject to required minimum distributions, or RMDs, at age 73. Roth distributions also do not count towards income thresholds for Medicare premiums or the 3.8% Medicare surtax on investment income. Let's look at an example to see how the Backdoor Roth IRA strategy works in practice. Let's say we have Bob. Bob is married, he participates in his company 401k plan, and he has a modified adjusted gross income of $300,000. Because of his income, he is ineligible to deduct a traditional IRA contribution or make a direct Roth IRA contribution. Without the Backdoor Roth IRA, Bob's next best option for additional savings would be a taxable brokerage account, where capital gains and dividends are taxed annually. The Backdoor Roth IRA allows Bob to direct those funds into his Roth IRA instead, where all future gains will be tax-free, even though his income prevents him from making a direct Roth IRA contribution. Bob makes a non-deductible contribution of $7,500 to his traditional IRA, then converts those after-tax dollars to his Roth IRA. This is a tax-free transaction. He will then benefit from long-term, tax-advantaged growth and tax-free distributions from his Roth IRA in retirement. Since Bob is married, his spouse can also execute a spousal Backdoor Roth IRA, doubling their available contribution from $7,500 to $15,000 annually. While these amounts may seem small compared to 401k contribution limits, the impact of tax-free compounding over time makes the Backdoor Roth IRA a powerful optimization tool for retirement savers. Now, let's discuss how the Backdoor Roth IRA is reported for tax purposes. When the conversion occurs, investors receive a Form 1099-R from their custodian, showing that a distribution from a traditional IRA has occurred. One of the biggest mistakes investors make when performing a Backdoor Roth IRA is failing to correctly report the transaction on Form 8606. This form tells the IRS what portion of the traditional IRA conversion is tax-free. For example, if an investor contributes $7,500 to a traditional IRA and has no prior pre-tax IRA balances, then 100% of the conversion will be tax-free. However, if the investor already has $7,500 in a traditional IRA from a pre-tax 401k rollover, then only 50% of their total $15,000 IRA balance is after tax. In this case, only 50% of the Roth conversion would be tax-free. This is known as the pro rata rule, and it's a common pitfall for investors executing Backdoor Roth conversions. The pro rata rule applies when an investor has pre-tax IRA balances from a prior 401k rollover or contributions made before exceeding the income limits for deductions. Before executing a Backdoor Roth IRA, carefully review your IRA balances for any pre-tax funds that might trigger the pro rata rule. As you can see, the Backdoor Roth IRA is a complex strategy that requires careful consideration of income limitations, tax reporting, and IRS rules. However, when implemented correctly, it is a powerful way to supercharge tax-advantaged savings for individuals already maxing out 401k contributions. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.